Welcome. You're listening to Mortgage Investing 101, the show where we discuss high-yield real estate mortgage-backed investment opportunities. I'm Edward Brown, your host, and I'm proud to introduce my co-host, Mark Hahn, president of Pacific Private Money, one of the fastest-growing private mortgage investment firms in Northern California. Our goal on this show is to provide information and to increase your awareness of these important alternative investment strategies where you can earn, get this, secured high yields using your savings or IRA accounts. Annual yields of 8% and more are not uncommon using these conservative strategies we're going to discuss in today's show. And if you like what you hear today, please call Pacific Private Money at 415-883-2150 for more information, or go to pacificprivatemoney.com. And for fun, we're going to have trivia contests where at commercial breaks, where the first three callers with the correct answer will win a free 3-day, 2-night vacation. The vacations are not sponsored by the radio station, but by Lighthouse Resort and Marina, located 1 hour northeast of San Francisco. And the vacations are free. Lighthouse is only requesting a $75 house cleaning fee. Check them out at lighthouse4fun.com. Today's trivia theme is one of Mark's favorite, the cartoon The Simpsons.
Oh, that'll be great.
Okay, Mark. We've had this show now for a few months. We've had some very good feedback from listeners. Give us a quick synopsis about what your company does, and then we'll get into the meat and potatoes.
Well, absolutely. Good morning, Edward. This is Mark Hanf. I'm president of Pacific Private Money. Our company is a real estate lender to the investment community, to real estate investors. So if you're someone or you know someone who likes to buy, fix, and flip real estate, or who likes to collect rental property, and you need financing, we're the type of company that provides that financing. Why do we provide that financing? Well, we've been doing it since 2008 because the banks no longer provide that financing.
Yep.
Many of you probably don't realize that ever since 2008, when we had the subprime and mortgage meltdown, the whole financial catastrophe, which is now 5 years, we just passed the 5-year anniversary of that, the banks largely stopped making loans to people buying investment property. Yet that has been, those people buying, fixing, and remodeling, and then reselling property has been really the source of the recovery in the real estate market.
Well, can I say that you're saving the country? Is that okay?
Well, I'd like to think that private lenders who have allowed their money to fund loans to real estate investors have really put their money to a great use. I mean, you could really feel good, and I certainly know a lot of my private lender clients feel great about putting their money to work that way. There is, the hard money and private money lending industry has taken its knocks over the years, and in many ways rightfully so. And it's been called predatory lending. It's been called a lot of different things. But when you look at the business model that really emerged in 2008, in fact, Pacific Private Money, my brokerage, we started in 2008. And so we're a 5-year-old company. We've made just over 600 loans, almost all of them to real estate investors, and probably 80% of those loans were to people who needed leverage to buy a property that they intended to remodel and then put back on the market. And another thing that the public might not be aware of, but one of the fallouts from the easy money of the early 2000s is that people were getting these appraisals that weren't worth the paper they were written on, that said their house was worth $300,000, $400,000, $500,000, $600,000 in the Bay Area, and these homes were in terrible condition. Many of them built in the 40s or 50s and 60s and never remodeled or hadn't been remodeled in decades, and they're getting these appraised values that are astronomical. And they're borrowing from that and pulling money out of them like a vending machine.
The appraisals, where did these appraisers come up with these numbers?
Well, they were basically made as instructed. It was really a circle of, you had mortgage brokers who were pressured from their employers to write loans because the owners of these mortgage companies were making tons of money by originating loan after loan. And real estate was going up, and everybody thought, well, this is a new world. They're not creating any new real estate. Real estate's always going to go up. And you remember what was happening from 2000 to 2006. Here in the Bay Area, in many markets, we were seeing annual rates of inflation or price appreciation, rather, of 15 to 20% year after year after year. I remember thinking to myself in 2002, 3, well,
can't go on forever.
Can't keep going up, and then it would again, and it would again, and it would again. And so anyway, 2008 comes and goes. We have the subprime meltdown. The banks basically pull out of making loans. And so companies like Pacific Private Money were formed to provide access to capital to contractors and rehabbers and remodelers. So not the hard money that you might think about or recall from a decade or so ago, which oftentimes was like a second to somebody who was in trouble, a distressed borrower, a desperate borrower, last resort type of lender. Sure, I'll make you a loan, 10 points and 20%. I mean, and there were guys out there that were doing that. Now those guys are largely out of business now, and it's in the industry's regulated today. You can't make loans like that. In fact, we don't make loans to homeowners typically in this market because there's a lot of new consumer protection laws enacted thanks to Dodd-Frank and other regulations.
When you say that homeowners, you're talking about specifically for the primary
residence, right?
Most homeowners are going to buy rental property,
sure.
And that's fine.
Right, so we're not making loans secured by a primary residence. That's not the business we're in anymore. It is a business, it is an investment model making loans to real estate investors. And so that's what we do at Pacific Private Money. And the source of the capital that we use to fund these loans at the title company, after the borrower comes in and signs all the loan documents, and the title company says, "Hey, we're ready to close. Wire your funds." Well, that money is coming from private individual clients, and so over the years at Pacific Private Money, we have attracted now close to 200 active private lenders. Most of these people live in the Bay Area. A lot of them are in Marin County, where our office is based. And some of these people are real estate professionals, retired, using their IRA accounts. They understand real estate, and for many of them, they look at this and they don't like me being on the radio talking about it because they think it's like the best kept secret ever that they can
Not
make
anymore.
8, 9, 10% on their money.
Okay, out of those, I'm going to put you on the hot seat. Out of those 200 clients, how many of them have ever lost money in any deal?
Through me, 0. So through Pacific Private Money, we of the 600 loans we've originated, not one investor has ever lost principal. In fact, every investor has received all of the interest that they were entitled to by contract on that
And
loan.
their principal back.
And their principal back, yes, indeed. So that's not to say people haven't lost money, because again, when the market turned in 07 and 08 and 09, people who had funded private seconds, a lot of them lost money. And I still run into people all the time. In fact, some of my active investors today who still love funding loans that we originate did lose money when the market turned. But it's just like the stock market. When you lose money in the stock market, you pull all your money out and say, "I'm never going to invest in stocks again." Well, maybe you do, but that's not necessarily a
prudent
logical or prudent decision to make to throw the baby out with the bathwater.
Okay, so here we, one of our quote taglines is that we say here that you can earn conservative, or excuse me, 8% or more on conservative investments.
Right, and that's key.
Why is this conservative?
Right. So in other words, is this risky? And we're saying not only is it not risky, but it's arguably, in our opinion, a conservative investment.
Okay, so it's not risk-free.
It's not risk-free.
Like the only thing that's not risk-free, I guess, is Treasury bills, because the government can just put more gasoline and just cranking out bills.
So if you're listening to this and you hear the word conservative and 8% or more, you're thinking these guys are on crack. There's no way that you can possibly. Yeah, it's an oxymoron. Absolutely. Well, it is true, and I'm going to explain how that can be. So we told you that we make loans to real estate investors. We're not making loans to people who can't afford to make the payments and they're late on their mortgage or whatever. These are people who, again, have made a business decision to borrow money at a high rate of interest. And that high rate of interest is anywhere from 9 to 12% on average.
Okay, and again, just for the listening audience, you're listening to Mortgage Investing 101 with Edward Brown and Mark Hanf of Pacific Private Money, 415-883-2150 for more information. I'm going to go back to that question, okay?
Well, we're talking about the conservative. I want to make sure we don't not answer that question.
No, that's true. But you're starting to answer the question, and you say these people or these borrowers are willing to pay high interest. Why are they willing to pay high interest?
Because the banks won't make that loan, and if the bank won't make them that loan, they don't have access to bank rate money. And if bank rate money is at 4% or 5% or whatever, it doesn't matter what the banks are charging. If the banks won't lend to a real estate investor because they're not funding non-primary residence
Okay,
acquisitions.
so these are borrowers who have opportunity to purchase another
Yes.
property cheaply. They're going to fix and flip it, or what some investment property, but they just can't get money from the bank.
And even if they could get money from the bank, because there are people out there that are wealthy enough, have enough credit and cash in the bank that they can go to their local community bank and say, "Hey, Joe, I'm going to buy some investment property.
Yeah.
You want to make me a loan?" They say, "Sure," but that's the exception, not the rule.
Or
and by the way,
the time.
the bank might make that loan, but it's not going to make it in a week.
Exactly.
And so a lot of our deals come to us. They're in contract. They got to close quickly because guess what? They put an all-cash offer in front of the seller, and the seller goes, "Oh, okay. How
Yep.
fast can you close?" "Well, I'll close in 2 weeks." And all the while knowing that they can come to a company like Pacific, and there's many of us out there, and we can close in a week, and we do it all the time.
And,
So
and a bank can't close that fast because they can't get an appraisal done.
they
that
can't get
quickly.
an appraisal like
And
that.
by law, with FIRE and all that,
Yeah.
they have to get these appraisals.
So we're still talking about, is it risky, and how could you say that we provide conservative returns of 8% or more? Well, here's the thing that we haven't talked about yet. We don't make high percentage loans to our borrowers. So if a borrower comes to me and says, "Hey,
You mean high loan to value?
high loan to
Right,
values,
right.
high percentage, right? We charge a high percentage rate on the note. Excuse me, sorry about that.
Yeah.
But we don't offer loans at a high loan to value. So here's an example. Someone calls me and they've got a house in contract in the Oakland Hills for $500,000, and it's in need of remodel, and it's in whatever condition it is. But houses up and down the street have sold in that neighborhood for $750,000 to $800,000, and so this
Okay,
guy's
so they're getting a good deal.
right. So they're getting a good deal. It might be a short sale. Oftentimes we do short sales, meaning that they're paying less than what's owed on the property. And so that $500,000 purchase contract, he sends me the contract, we pull his credit, we collect his income, we do all the things we do in an underwriting. We underwrite oftentimes much like the banks do, we're just faster at it. We'll offer to make him a loan of up to $350,000 on that $500,000 purchase. That happens to equal 70% of the purchase price. 70% is our
Okay.
maximum loan to value on a loan, and we base it on the purchase price, not on what the after repair value is.
That's very important.
Yeah.
Okay. So the borrower in that case is going to have to come up with $150,000 cash
Yes,
plus your $350 borrowing to close the deal.
right.
And what are you going to charge that borrower? Because sounds like a pretty safe loan. I mean, if the property's worth 700 plus thousand.
Well, repaired.
Repaired.
I mean,
Okay,
it's
how
worth
much-
what he's paying for it. I mean, guys
Okay,
come to me all the
fair
time and
enough.
say, "Hey, I got a house under contract for $500,000. It's worth $6." I'll say, "Well, maybe it is, but as far as I'm concerned, it's worth $500 because that's
Yeah.
what you're paying for it. And I'm going to make you a loan based on that price. So we'll make him a loan of $350,000. We'll probably charge him between 10 and 11%.
Holy smokes!
And I'll charge him some points,
Okay.
and then and some closing costs, some so-called junk fees, which is really paid to our processors and the admin people who work, staff that work in our
And
office.
I'm guessing that his remodel costs have to be less than 200,000, or else it's not going to make sense for him to sell it for 700,000.
Well,
Right.
he hopes so.
Yeah.
Do I really care if he makes a profit on that or not? Now, I do, because a lot of my clients are repeat clients,
Yeah,
and I
sure.
like them, and I want
Yeah.
them to make a profit. I want them to keep doing this. I want them to keep coming back to us.
As long as he
Well,
sells the property for more than 350,000,
That's-
you'll get paid back.
That's what I
plus
care
interest.
for.
Yeah.
So here is how it's another reason how it's conservative. We only lend to 70%. He's got to come in with his own money or his own financial backing to close the property with a 30% down payment plus closing costs. He has to fund his own remodel, and as he's remodeling that property, the property's improving in value. So by the time he's done and he puts it on the market for $800,000, I've got a $350,000 loan secured by a property that's now worth
42% loan
yeah,
value.
it's
or whatever.
amazing.
Yeah.
So now, is there a risk? Well, of course there is. The risk is he goes in, he starts remodeling, and he runs out of money, and he stops. He doesn't make payments on the loan. The
Okay.
house is halfway
Half done,
torn
yeah.
apart or whatever it is. He's taken down the sheetrock and pulled out wires and started taking the house apart inside or outside or whatever. Not that, and I'm going to tell you, this has not happened to us yet.
Okay.
This has not happened to us yet, but I know it does happen, and it's happened to some lenders out there. We would foreclose on the property, we would take it over, and we would finish it and sell it presumably at a profit. So really there is risk. There's also there's insurance, there's personal guarantees. There's a lot of ways that we can compel the borrower to perform. But in the worst case situation, we would have to take it over and finish it. Now again, we have not had to do that yet, and one of the reasons is because we don't just lend to everybody. We don't generally loan to inexperienced. Hey, I want to be a real estate investor, but I've never done it before.
Well, also, I'm not gonna, as a borrower, I'm not gonna like set myself up for a downfall purposely. To invest $150,000 plus whatever it costs me to remodel just to walk away.
Right.
So I'll do whatever I can to try to sell. Stay with us, Mark Hanf of Pacific Private Money, 415-883-2150 for more information. Again, we're gonna get into a specific deal of the week next segment so that you can actually hear, audience, how these loans actually work. Here's our first commercial break. Again, the theme is the cartoon The Simpsons. Figured get a little fun here today. What is the name of the guy who runs the Quickie Mart who has been known to say, "Please do not feed peanuts to my God"? The first 3 callers with the correct answer win a free 3-day, 2-night stay at the Lighthouse Resort. Their website is lighthouse4fun.com. Call 888-529-1134. That's 888-529-1134 to answer this question. What is the name of the guy who runs the Quickie Mart in the Simpsons cartoon who has been known to say, "Please do not feed peanuts to my God"? 888-529-1134. Make sure to include your name, email address, speak slowly, spell out your email one letter at a time. Don't touch that dial. Mortgage Investing 101 will be right back with Mark Hanf and Edward Brown, and we're going to talk about the deal of the week where clients are earning 8% or more conservatively on real estate mortgage-backed investments. And I think it's a good idea to just concentrate on the fund. Let's not confuse people with individual ones.
Yeah. Right. So we'll do. We didn't do this one in the fund, but I think we'll talk about
That's
it
okay.
anyway. So another bridge loan situation. Well, maybe no, we don't. Again, if we don't want to confuse it, we want to just keep it.
It doesn't matter if a specific deal is in the fund or not. You just talk about generally.
So let me because again, I want to try to clear my brain, and I know we're going to go to the next section. What?
Can't figure out
Which one did you fund today?
The Gutierrez in Napa. Oh yeah, because that one. What was it? The FICO score just was a little bit too low for the bank temporarily.
That is the fun deal. Yeah, that's Gutierrez. Napa Gutierrez. Yes, that was $650. I think was the purchase price and 70%. So I'll just again, the numbers, the exact numbers aren't relevant.
No, it's not the high. Because I only funded 270.
270, right?
So 270 divided by 70%, it was 385,000.
385. That's right. 385.
Now this one was their personal residence.
Yes.
Let me just see here. Welcome back to Mortgage Investing 101. I'm Edward Brown, your host, along with Mark Hunt, president of Pacific Private Money, California's fastest growing private mortgage investment firm in Northern California. When we cut to the first commercial break, we asked this trivia question. The theme is the cartoon The Simpsons. What is the name of the guy who runs the Quickie Mart, who has been known to say, "Please do not feed peanuts to my God"?
Now, if this were questions about Family Guy, I just would nail each one.
Yeah.
This one, I'm forgetting his name now.
Apu.
Oh, that's right.
That's right, Apu. Okay.
Okay.
All right.
No
Now,
comment on that name.
yeah, well, that's just the name of The Simpsons. Okay. Which, by the way, in Family Guy, they killed Brian, didn't they? Well,
I know.
temporarily. We'll
Well.
find out. Okay, so the name of the show is called Mortgage Investing 101. We promised the listeners that when we came back from commercial break, we were going to get into the deal of the week so that the audience can actually understand a specific deal, not just theoretical, but give us a specific deal that you recently closed.
Well, I'm going to talk about two deals. One that actually hasn't closed yet. It's going to close next week. It is an application from one of my repeat borrower clients who's actually working with a new client of his who fell into an opportunity to buy a home in the Oakland Hills near Piedmont, and she's buying this property for $600,000. Now, we had a BPO done on the property, which stands for Broker Price Opinion. It's like an appraisal, but I can get these reports oftentimes in as quickly as 24 hours, and generally within 48 hours. I've got a company that will go out and take pictures inside and out, and they will give me a valuation estimate. Oftentimes, for someone like me, it's a better valuation estimate than an appraisal. And
Why is that?
you know, it's appraisers are bound by a number of restrictions and
Good point.
practices and procedures and policies that they have to adhere to, and it's not always in the best interest of someone like me who really wants to know what's that property, what can I sell that for in a pinch, or what's that property likely to be worth after certain things are done. So
Okay.
the
Fair enough.
appraisals are made for the banking industry. We're not the banking industry. I'm looking at it from a different perspective. I'm looking at it more of a likely resale price, as well as I want to know, because oftentimes people do get properties at a price that's below market. Well, if you have an appraisal done, they're just going to look at the contract and they will always come in at the contract price. That's the problem with appraisals in a nutshell.
Yeah.
If she's buying it for $500, I will bet anyone $1,000 that 5 appraisals, 10 appraisals, 25 appraisals will all come in at $500.
You almost wonder why they even need to do it then.
I have investors who tell me don't even bother getting an appraisal because it's just not worth the paper it's written on. Now, no offense to appraisers, because they're there to serve a market, and they're highly regulated. It's not their fault.
Sure.
So if I want to know what the real value is of the property, because I've got an investor who's telling me, I just got this great deal, it's a short sale, or it's, in this case, in the Oakland Hills, it's off market, meaning it's not listed on the multiple listing. It's not listed. It's not in the papers. It's not listed with a real estate agent. It's owned by a church, and she has an affiliation with this church, and they're selling this property. And she negotiated this an
Now, is it
excellent
actually
price.
a church?
No,
that
no,
she's
no.
buying?
It's not.
No.
It's a
Okay.
house.
Like a parsonage or
Right,
something.
that was being rented out by the church, and they no longer wish to retain the property, so they're selling it.
They maybe need the money for other.
Yeah,
things.
I don't know the inside details yet,
Okay.
but I may get the backstory on it. But anyway, she's in contract on this home for for $600,000, and all the properties of similar size and condition up and down the street are around $750 in value. So
Okay.
and that's
And
what
she doesn't have to pay commissions, or the church probably doesn't have to pay commissions because it's an inside job.
Right,
Kind of deal.
exactly. So we've got a situation where our broker price opinion came in and said this property is probably worth $750,000 as is. Well, she's going to buy it. She's going to do some remodeling, then put it on the market, and the person I'm working with thinks that it's probably going to fetch somewhere between $800,000 and $900,000. Again, I don't really care. I just care that it's going to go up in value, and I
Sure.
trust, because of experience with this borrower client, I trust that he's going to do his typical quality workmanship
Okay,
and
so
put it back on the market.
So just to refresh for the audience here, this person's getting a pretty smoking deal
Yeah.
by buying a property that's right now, as is, worth $750,000, but is only buying it for
$600,000.
$600,000.
And
then he's going to he is going to
She and a he.
She and he. Okay, they
They.
are going to improve the property past the 750 value. So how much are you lending on this?
I'm making them a loan equal to 70% of the acquisition price.
So
Of
$600,000, so $420,000.
So I make a $420,000 loan.
Okay.
And I'm not giving them any kind of special deal or discount on the pricing because they're getting a smoking deal. Hey, they're getting a smoking deal. So
yeah, they can afford to pay.
as far as I'm concerned, right. I mean, and I'm providing them with a quick loan that will allow them to close this deal before the end of the year. I got the phone call this week. So this is a deal where, I got a call from, my client Richard, and he said, "Hey, Mark, I know you probably don't want to hear this because you're thinking about Christmas, but I've got an opportunity here. Could you close another loan before Christmas?"
Well, this
And he
happens
said-
a lot.
It does.
Because a lot of times, for whatever reason, the seller needs to close before the end of the year.
Yeah, absolutely. So a quick close was needed. It's an off-market transaction. The client is getting a smoking deal, as you called it, and I concur with that based on our analysis and third-party analysis. We're going to make a loan of $420,000. We're going to charge a 10.5% interest rate. We're going to charge 3 points plus our documentation and processing. We're going to close quickly. She's going to get that smoking deal. We're going to make good fees in our fund, the Pacific Private Money Fund, which we're going to talk a little bit more about later. And so that's example number one. Now,
what kind of FICO score do they have, or credit score do they have?
this one, she's in the high sixes. So,
Okay, so
she's bank financeable.
She's bank financeable, but she has to close within less than 2 weeks.
Less than 2 weeks, right? And so probably for that reason alone, really, she's going to come to the services of a private money lender and not a bank because she can't risk not getting this deal.
So she's got $180,000 cash to put down because you're only going to lend her $420,000.
Right.
Plus, she's going to put how much into the property? You think?
Somewhere between 50,000. Yeah.
Okay, so she's got at least a couple $100,000. All right, go on.
So that's one.
You're intriguing me.
And I could probably give you an example of a dozen other loans that are similar to this. Maybe not as smoking a deal, but it's just someone who's buying a property that's got upside potential. But
okay.
I want to tell you about another loan that actually you're very familiar with, and this is a loan again that our mortgage pool fund provided the loans for. It is in Napa, and I get a call on Monday, and it's from Jeremy, who's been on our show, and he's a well-known and very, very competent and successful mortgage loan originator, conventional mortgage loan originator in the Bay Area. Jeremy calls me and goes, "Mark, I got a deal that I know you're going to hate me for asking you this, but I got a deal. It's actually, he called me on Tuesday morning. It wasn't even Monday. So Tuesday morning he calls me, I've got a buyer. It has to close on Friday, or she's going to lose this
4 days,
great opportunity to buy a home in Napa for $385,000. Now I pull it up online right away, and it's a single-family home. It's not a condo. It's not a townhouse. It's a single-family home built in a newer subdivision in 2005.
I saw the pictures, and it's a very cute community.
Unbelievable, $385,000. If she can't close, they have a backup offer, all cash, ready to swoop in. And she
for how much?
Well, I think more than $385,000. Again, I didn't know that detail. I just was told by the parties involved that if I can't close on Friday, this family loses this opportunity to buy this house. They had a hard deposit, and they were bank approved until the bank repulled their credit.
Explain what a hard deposit is for our audience.
Well, they had, they put $5,000 down. They're not going to get that back.
So they're going to lose that money.
They're going to lose that money.
Actually, this one, in this case, this was going to be their primary residence.
That's the difference. Now, I spent a lot of time in the first segment talking about how we don't make loans on primary residences. There are exceptions, and there's an exception to the stringent owner-occupied primary residence loan laws, and that is in the event that a bridge loan is required. And a bridge loan is defined as a loan that's less than 1 year in term and is used to purchase a property, and it's allowable when there is a clear exit strategy, meaning they're going to be able to repay it, and in this case they're going to be able to repay it with a conventional loan, which is going to take them about 60 days to requalify for that conventional financing.
Yeah, what happened? Why was it a situation where there was only 4 days to close?
Well, the bank had approved their loan, and the bank was going to provide the funding for them to close. They repulled the credit, as they oftentimes do during a transaction that takes more than 60 days, and that was the case in this transaction. When they repulled the credit at the end to make sure everything was okay, because what sometimes happens, people are in contract to buy a house and then they go buy a car, or they go take out new credit, and it makes their score go down.
Yeah.
Well, that's not what happened in this case. I won't get into details as to what happened, but there was a glitch, and it's a fixable glitch, but their score dropped below the minimum threshold required by the bank, and the bank said, oops, we're sorry, but we won't be able to close this transaction until we get you rescored back at that minimum level.
And
can you get an extension on the
Yeah, yeah.
contract? Well, the answer
No.
was no.
Well, and the interesting thing is that, and I think I found this out from I'm trying to remember if I found this out from the bankers. It's not really even their fault. It's the regulators and the auditors who
Yeah.
basically, when they find out that you've made loans to people who have credit scores below a certain threshold, there's all kinds of penalties, or there's bad things that happen to them. So it's not that necessarily the banks want to be mean, but if you don't meet their in the box routine, they're just not really allowed to do it. So this was a couple that actually did fit in the box,
Yes.
but suddenly they came out of the box because of some kind of glitch.
So
And that glitch you said is going to get fixed?
it's going to get fixed. It's fixable, and we have made over, I would say, close to. Well, let me back up. This year, we're closing out December. We're closing out 2013. Pacific Private Money will have originated about 150 loans for the year. Of those 150, I would say maybe 20 of them were these short-term bridge loans where the borrower was approved and had planned to close their primary residence acquisition, their new primary residence acquisition, using a bank loan, and then fell out last minute and came to us and requested a private money loan to close. Now, do they want to pay the 2.5, 3 points and 9% or 10%? No, of course they don't. Now we did sharpen our pencil a little bit. I backed off a little on the points and a little on the interest rate. Again, I want to help these people. I want to make Jeremy look good. I want everybody to be happy. It's still not inexpensive money, but
Okay,
they don't lose the deposit and they get their dream home.
Exactly. Okay. What were the terms of this NAPA?
9.9%.
Okay, so roughly 10%.
2.5 points on the
2.5
exit,
points.
and in our regular junk fees. Again, we didn't add anything. No more, no less. Again,
Now,
very consistent.
So, are you going to get cashed out in 60 days because they're going to get the bank loan, or is there?
As long as we're cashed out in the 11-month term that we made the loan, that's really all we care about. Although, the way the money fund, the Pacific Private Money Fund is designed, if they pay off the loan in less than 60 days, it's actually better for our shareholders because we'll reloan that money back out right away. And the reason it's better is because the Pacific Private Money Fund, we share the origination points with the shareholders on loans that the fund makes. So again, that's something we'll talk about.
Yeah. So theoretically, if you could churn the money every 30 days, that'd be fantastic.
Right.
So, and we're going to get into that in the next segment because I want to talk about exactly what the fund is. How does it work? Do you have minimum guarantees of interest?
Right.
In some cases, I know you do.
All the nuances of a mortgage pool fund.
Exactly. Okay, so first of all, again, audience, you're listening to Mortgage Investing 101. I'm Edward Brown, your host, along with Mark Hunt, president of Pacific Private Money. Mark, what's your phone number if people want more information?
We're here in the Bay Area at 415-883-2150. If you're trying to memorize that number and want to just pick up your phone and legally make a call and leave us a message, I'll be happy to return that call and chat with you next week. Again, 415-883-2150, or visit our website at pacificmoneyfund.com. That's all one word, of course, pacificmoneyfund.com.
Very simple. Okay, the second commercial break, and the trivia theme is the cartoon The Simpsons. Here's the question. What is the name of Homer's neighbor who usually says, "Hi diddly do"? The first 3 callers with the correct answer win a free 3-day, 2-night stay at the Lighthouse Resort. Their website is lighthouse4fun.com. Call 888-529-1134. That's 529-1134 to answer this question. What is the name of Homer's neighbor, and again we're talking The Simpsons here, who usually says, "Hi diddly doo"? Call 888-529. Excuse me, I lose my
Easy
throat
for you
here.
to say.
Yeah, really. Make sure to include your name, your email address, speak slowly, spell out your email one letter at a time. Don't touch that dial, because when Mortgage Investing 101 comes back, Mark Hunt will explain exactly how you can invest conservatively, earning 8%. You've been listening to the show, and he will get into more detail about investing in the fund. We'll be right back.
Excuse me. Something I just flashed on that we haven't talked about yet.
Okay.
I'm just trying to remember something. There's something I just flashed on that we oftentimes talk about. Mentions we have the fund.
There is. I've got that before.
And I just spaced on that.
How can you watch Family Guy but not know about The Simpsons?
I just stopped watching him a while back, and there's only so much time, so it's just it's really Family Guy. I see Simpsons, I just don't record it.
Anything specific about one of the loans?
It's all right. I'll probably remember as we're talking.
Okay. Oh, we gotta figure out how much I've got.
And I don't know the answer, so I'm going to guess.
Okay. Okay, we've got 14 minutes and 26
Awesome.
14:26. Okay. Welcome back to Mortgage Investing 101. I'm Edward Brown, your host, along with Mark Hahn, president of Pacific Private Money, one of the fastest growing private mortgage investment firms in Northern California. When we cut to the second commercial break, we asked this trivia question. What is the name of Homer's neighbor who usually says, "Hi diddly doo"?
Krusty the Clown.
No. Ned Flanders.
Oh, that's right. That idiot.
Yeah. Okay. Mark, we've been talking about investing in mortgages, earning 8% very conservatively. How do listeners, if they're really interested in this, how do they invest with you?
Well, it's very simple. Our main product at Pacific Private Money is a mortgage pool fund. It's a regulated, called a Reg D mortgage pool fund. It's regulated by the SEC, and in terms of how it's put together, Reg D mortgage pool fund.
So you are regulated.
Yeah, so Pacific Private Money Fund is what it's called, and that fund has a number of nuances that I think are very compelling. We believe are very compelling to the investors, and in fact, we've got quite a few recent investors to the fund, and we'll talk a little bit about that later. But really, what sets apart mortgage pool funds, generally speaking, and the benefits of investing in a product like that are several, and it includes things like diversification, because your risk is spread over all of the loans in the fund. It's like a mutual fund of real estate secured loans. It's convenient because you can invest anytime you want. You're not waiting for a specific loan. You can participate in dividend reinvestment that allows you to benefit from the increase due to compounding, particularly if you're investing with your self-directed IRA, or if you have a Roth IRA and you don't need the distributions. That's a great way to grow your savings even more. And there is a mode of liquidity, because people who invest in an individual note, by and large, those aren't that liquid, except there's a secondary market.
That's okay. We'll just concentrate on the fund.
But on the fund side, the liquidity is that after you've kept the money in for the minimum investment period, which in our case is 2 years, you can redeem that money free of charge.
Okay, so there's no charge to get in. There's no charge to get out.
It is a no load, no fee investment. That's
Okay.
another really interesting
Very
thing. Very important. So you're not paying any fees to get in. It's a $50,000 minimum investment, and you must be an accredited investor. Now that's important, thanks to a lot of these new regulations that we are regulated by. You have to be an accredited investor, and that's defined as having a net worth of $1 million or more, not including the equity in your home. So if you have a net worth, the total of all your assets minus your liabilities, you have a net worth of $1 million or more, not including the equity in your home, then you qualify to invest in the Pacific Private Money Fund. A couple of other benefits that we have in there is that we designed this fund really to profit from the type of market that we're lending in here in the Bay Area. So we talk about how most of our loans are to real estate investors. Well, another reality of those loans is they're short term. So most of these loans get paid back within 6 months. Many of them within 60 to 90 days. It's amazing how short term some of these.
Well, if I'm a borrower, I really don't want to pay. As much as I like you, Mark, I really wouldn't want to pay you 10% interest if I didn't have to.
Right. That's exactly right. We don't make many long-term loans. There are some loans in the portfolio that are longer than a year, but that's really rare because again, who wants to pay 10% longer than they have to?
Yeah.
So there's short-term loans in the fund, and one of the ways we increase the yield on the shareholders in the fund is that you heard about origination points.
Yep.
Origination fees, also called points. 1 point is equal to 1% of the loan amount. So on a $500,000 loan, 1 point is $5,000. We typically charge 2 to 3 points on a loan. So let's say we do charge 3 points on a $500,000 loan. That's $15,000 in fees that are paid by the borrower when the loan closes. Realistically, what happens is that money gets deducted from the loan. So we fund the full $500,000 to escrow, and we pay ourselves back the fees, the origination fees of $15,000, plus there'll be some documentation and processing fees.
Does that all go to you?
No, it does not. 50% of that, half of that, which is usually the house share, because we pay our agents from those origination fees, and most of our agents are on a 50% program. The house share of the fees, or 50% of the funds, gets paid also to the mortgage pool fund for the benefit of the shareholders. So shareholders, the return to shareholders in the Pacific Private Money Fund is created two ways. It's created, number one, by the interest paid by the borrower on the loan, which could be anywhere from 8 to 12%, plus the 50% share of the origination fees. And so we have a preferred return that we pay right now to the shareholders of 7%. Then we split the profits above that 7%, 50-50, with the shareholders and the manager of the fund, which is Pacific Private Money. And in the third quarter of 2013, this past third quarter, we had a distribution to shareholders that was at an annualized rate of 8.9%. And we were able to do that because we are making conservative short-term loans at pricing that allows us to be aggressive and to get quality loan applications, but because we're sharing in the points with the fund, that allows us to still return yields approaching 9%.
Okay, two questions. One, what if I have this in an IRA? Because I remember part of the tagline we have here is that you can invest your IRA. Well, I don't need the money. I want it to compound. Can I do that?
So the way the fund is designed is we make quarterly distributions, not monthly, and that's meant to save on the administrative fees for the fund. We've got a third-party administrator, and their fees are very, very low, about a third of a percent, and it decreases as the fund grows in size. Very, very cost-effective. We make quarterly distributions if the shareholder elects to receive them. Now, you don't have to receive those quarterly distributions if you would rather have those distributions instead purchase additional shares.
So you can compound your yield then.
Right. So in the case of that 8.9% annualized, that was on a simple interest basis. So over the course of 4 quarters, if that were consistent, you would actually, and I don't have my calculator here to figure it out, and I
Probably 9.25, probably.
right, or about 3/8, something like that, something.
Okay, one more question here. You said the minimum term to lock my money up is 2 years. Is there any circumstance that I can get out before 2 years?
Oh yeah, early redemption is possible. I mean, you basically just ask for the money, and then we will pay it to you out of new investor dollars or payoffs, loan payoffs, at the first of every month. First of every month, we will honor redemption requests. Now, if it's under 2 years, there will be a redemption penalty. Now, that penalty starts out at 5% for the first 6 months, and then every 6 months thereafter it goes down a percentage point. So it goes from 5 to 4 to 3 to 2, and then at the end of by then you're at 24 months anyway, so it would be 0 then after that.
Okay, so if I decided after 1 year, let's say you consistently paid what you're paying is 8.9%, and right after 1 year, I decide I want to get out, then it sounds like there's a 4% penalty.
Well, if it's after 1 year, if it's 14 months after you've made that investment, it would be a 3%.
3%. Okay, so let's say right after a year, it's 3%. So 8.9% minus 3% is 5.9% that I would net. That's not a bad deal for a 1 year like CD type of.
Right, that's still a pretty good loan, and the reason we have the minimum
Good
investment period is we don't want people to treat this like a money market account. I mean, we're in business to make loans. We need to have a certain we need an ability to have an expectation and a budget of the monies we have, because we're making promises to our borrower clients in terms of timing for these loans, and so we need to have a certain reliance on the availability of capital. So if we're constantly honoring redemption requests, then that becomes a problem. So, and again, for most people, a 2-year hold is not a big deal.
No,
in fact,
it's
a lot
really
of funds out there have 5- and 7-year
Yeah.
holds. In fact, we designed this fund to work in the market that we're in here in 2013, 2014, in the Bay Area, where we have some of the, believe it or not, some of the least expensive hard money, private money in the country.
Yeah. Remind people who you are and what the name of the show and why are they listening to this show?
So you're listening to Mortgage Investing 101 to learn how you can, with safety and security features not found in stocks, earn yields on your savings of 8% or more, and through a product known as a mortgage pool fund, where we produce those yields by making loans to real estate investors secured by largely Bay Area real estate. That's another comment we didn't make yet.
I was just going to say
is that we're based here in Northern California. We're in the Bay Area. My personal experience is over 30 years in the Bay Area real estate market, 5 years originating loans, and 90% of the deal flow we produce is loans right here in the Bay Area and Sacramento. Now, we also do loans in Southern California as well, and we've got we have agents down there, and we've got investors down there. So, but by and large, it's really Bay Area focused real estate.
And how do you make your money? Because you said, I know you're splitting the points with the fund.
Well, there's also a management fee. So, every fund has a management fee. There's what they call the distribution order is first the expenses of the fund, including the fund administrator, get paid, then the manager gets paid, then the 7% preferred return goes to the shareholders, and then what's left is known as the profit, or the excess distributable cash, as we call it in the private placement memorandum, and that gets split 50-50 with the shareholders.
And all of that, in a nutshell, produced an 8.9% to the shareholders.
Yes.
Because you're charging the borrower roughly 10% or more plus some points.
Plus the points, right? Plus the origination fees. So it's
We've got a couple of minutes left. What else do you want to share with us?
Well, the other thing about the fund is that we designed it to be very transparent. We're still working on our investor portal to put up some more of the disclosure documents that we talked about in our initial presentations to our investors and our shareholders. So, transparency is something that we're really big on. So, shareholders of the fund will be able to go to the investor portal and not only view any and all the fund documents, but Also look at our underwriting guidelines. Take a look at things like our orderly liquidation plan, our disaster recovery plan. We have everything in place to adequately protect the shareholders in the event that something unexpected happens. And so again, transparency is very, very big. My entire career in real estate and more specifically in mortgage loan origination has really been around transparency. So if you go and Google Pacific Private Money, you'll see all our various websites and LinkedIn profiles. You'll see all my staff. We have our pictures up there, our names, our bios, our email addresses. Unlike a lot of companies on the web, we don't hide behind an 800 number, a picture of a skyscraper, a stock photo of a couple of guys in suits shaking hands, and then you can't find out anything about the principles behind that. And so again, transparency rules the roost in this business, specifically because we're dealing with people's retirement savings.
Okay,
Very
so
sensitive
with
about
just
that.
a little bit of time to go, again, remind people how to get a hold of you to get 8% or more on their money.
Well, here's even better news. If you tuned in late and you want to hear one of the shows in its entirety, or some of the prior shows where we've talked about this and other issues around mortgage investing, go to our website, Mortgage Investing 101. That's the radio show website, mortgageinvesting101.com. We have all of our past broadcasts on there, and so you can download a podcast and listen to our show at your convenience.
Very good. Okay, tune in next week to Mortgage Investing 101. We're going to be giving away more vacations for answering trivia questions and giving more valuable information about mortgage investing. Thanks for listening. I'm your host, Edward Brown, and on behalf of Mortgage Investing 101, so long. We'll catch you next week.
It's a busy Thursday. I'm collecting 4 or 5 people. Call me